Dollarama stock is up 8% today after the company reported earnings numbers. So I'm going to dive into how the company did, why it's doing well, and whether it's worth buying the stock right now. So this morning it reported its second quarter earnings numbers, and two things that really stuck out as really impressive for me was the fact that not just the sales growth was 7.4%, really solid year over year, but also the comparable store sales number was really solid, 4.7%. So the difference between the two is sales is just overall sales, whereas comparable store sales, that looks at the same stores that were open a year ago. So 4.7%, really solid number. The fact that its existing stores are also generating growth, not just Dollarama getting a boost from new store openings. That's a really positive thing to see. Another thing that was really good was operating income was up by 15.3%. And, its operating margin was 27% versus 25.2%. So while some dollar stores are struggling with prices and margins, Dollarama is doing really well, and their margins are actually improving. So that's a really positive sign that the business is doing well. And so they're talking about, strong traffic trends. And so overall, not really the same sort of issues that some people have seen in US stores like Dollar Tree or Dollar General. And if you look at Dollar General a few weeks ago, they were talking about a financially constrained core customer. They were down 25%. Dollar Tree also struggling due to macroeconomic conditions. They were down 22%. And so what I found was really interesting was that if we look at Dollarama's stock, so it's up 8% today, but look what happened right around, this was August 29th. So right after Dollar General talks about a financially constrained customer, Dollarama's stock starts to tank just before earnings. So I think what's happened was a lot of investors were expecting, Dollar Tree was struggling, Dollar General was struggling, then obviously Dollarama should be struggling as well too. But it proved that that isn't the case. And Dollarama stock, the fact that it did so well, got it right back up to where it was before that little brief sell-off started to happen. So I think a lot of people were expecting that Dollarama was going to do just as poorly or face the same sort of challenges as Dollar Tree and Dollar General. But one thing that's really appealing about the Canadian retailer is that Dollarama stores, they're usually fairly tidy, well taken care of, well staffed. Whereas, if you look up YouTube videos about Dollar General or Dollar Tree, you'll often find people complaining about not enough staff and the stores being in disarray. And so you don't have that with Dollarama. It's generally a better shopping experience. They do have, some higher priced items. You can find items for $4, $5. And so that allows their margins to be a lot better. And it's a lot easier for them to grow their sales as well, because if they're introducing new products, they can have a wider variety of products, that allows them to be able to generate better results overall. So for those reasons, I guess it may not be too surprising that Dollarama did well. I guess it's still a bit of something that's unexpected based on how you saw the markets reacting here. So overall, it's done fairly well. So up 8%. Based on earnings. Year to date, 42%. So, this is a solid stock to buy. The only thing that would prevent me from buying the stock really is that it's not a cheap stock. So right now, its PE ratio is about 37 times earnings. You can see its 10-year average is 29. So it's fairly expensive compared to how it's been in the past. Stocks like Dollar Tree, Dollar General, even though let's say they're not as good as Dollarama, they're trading at around 10 or 11 times next year's earnings. So this is significantly less than Dollarama. But that being said, Dollarama is a much better dollar store, I would say. Now, and if you look at its performance over the years, so 12 months, 55%, 2 years, 68%, 5 years, 180%, this is a stock that continually goes up and up and up. So even though its earnings multiple may seem a bit high, it may be justifiable given how well the business is going and how well it's doing. So, if you're debating whether to put this stock into, if you're a Canadian investor and have a TFSA, I'd say it's a good stock to put in there just because you can hang on to it for the long term. And it's one of the best Canadian stocks you can probably own, right up there with Alimentation Couche-Tard, the convenience store operator. So I think Dollarama is a really good stock if you're buying long term. I think in the short term, because its multiple is a bit high, I think it could start to come down, especially if there's a recession and its comparable sales numbers start to slow down, and perhaps it struggles if Canadian consumers start to pull back on spending as well. So I wouldn't be surprised if there's still another drop. So if you're looking more for a short term trade, I would say you're probably better off holding off until the Canadian economy starts to slow down a little bit and then buy it. But if you're buying it for the long term, I think it's still a pretty awesome stock to buy. And the latest earnings numbers, I think, prove that this is a much better stock than other US discount retailers. And so even if you're paying a bit more of a premium for it, it might still be justifiable and worth it. So a really good stock all around. So I think a really good option for the long haul.